Fed meeting, hawkish pause may cap upside for S&P 500. The Federal Reserve dovish hike on May 3 helped set the stage for the next phase of the S&P 500 rally that has followed. Despite hiking its key interest rate above 5%, the Fed, by dropping its bias towards additional rate hikes, essentially gave the stock market room to run. Today, we could be in for the reverse. The Federal Reserve looks certain to keep a rate hike, sticking to its guidance. However, Wall Street expects policymakers to signal the intent to hike again, barring a pronounced softening of the job market and core services inflation. Just how hawkish the Fed's signal are tomorrow will likely determine how the S&P 500 responds. Federal Reserve meeting statement. Now the Fed will have 3 ways to signal that the June pause in rate hikes is probably over. The policy statements, new economic projections, and Chairman Jerome Powell's post-meeting news conference. Now Deutsche Bank economists expect the Fed to use all 3. Now we expect the statement will be hawkishly adjusted to note the potential for further tightening at the coming meetings. Deutsche Bank economists wrote, the compilation of each Fed policymaker's federal funds rate projection, known as the dot plot, also is likely to show an additional hike, they predict. Now, Father Powell's message should skew hawkish given resilient economic data and easing financial conditions. Deutsche Bank economists anticipate one further quarter-point hike to a range of 5.25% to 5.5% at the July 26 meeting. If the Fed wants to send a message to investors and potentially stifle a more powerful S&P 500 rally that could offset monetary tightening, look for a change in the policy statement. On May 3, the Fed dropped language indicating that the policymaking committee anticipates some additional policy firming. In its place, the new Fed meeting statement pledged to closely monitor incoming data to assess the extent to which additional firming may be appropriate. Now, in other words, policymakers no longer anticipate rate hikes, but would reconsider if economic data warranted rate hike projection. Now, the question is whether the data warrant a hike. Part of the Fed's calculation will be whether financial conditions, of which stock prices are one important reflection, may have eased too much to achieve policymakers' goal of bringing down inflation and wage growth. Now, the latest batch of quarterly projections in March show that a clear minority of policymakers, 7 of 18, expected the federal fund rate to peak above the current 5% to 5.25% range. Only 4 of 18 expected multiple hikes above the current level. The S&P 500 is likely to behave better if the new projections show the Fed is closely divided over an additional hike. But if a strong majority is now inclined to hike again, the stock market would likely take note. After the CPI report showed headline inflation falling to 4% on Tuesday, market are pricing in just 5% odd of a rate hike, down from around 20% on Monday. But markets still see around 66% odds of a July hike, according to the CME Fed Watch 2, the Fed's summer break. Now, Chair Powell said after the May 3 Federal Reserve meeting that policymakers could afford to look at the data and make a careful assessment. The lagged impact of rate hikes and the outflow of deposits from regional banks both pointed to a softening of the economy, he indicated. Yet so far, the economic data has come in mixed. An array of leading indicators now point to recession, wrote Ian Shepardson, chief economist at Pantheon Microeconomics. They include the National Federation of Independent Business monthly survey, various manufacturing survey, and declining bank lending. Now, both employment gains and the Fed's key inflation gauge remains well above policymakers' comfort zone, but it is just a matter of time before they buckle, Shepardson said. Now, the key question is whether it will happen in time for the Fed's July meeting. After that comes the Fed summer break. The subsequent meeting isn't for 8 weeks, so the Fed may need to see clear evidence of economic weakness to skip a rate hike next month. That leaves only 2 CPI reports, including tomorrow's, and 1 monthly job report. S&P 500. Now, the S&P 500 rose 0.65% in Tuesday's stock market action. That followed Monday's 0.9% for the S&P 500 since April 2022. S&P 500 futures are pointing slightly higher early Wednesday. Now, the S&P 500's climb of more than 20% of October bear market low means we are in a new bull market. Stock market history would suggest one more gain will follow over the next year, though a potential recession could create quite a detour. On top of a likely additional rate hike, the S&P 500 also will have to withstand the contrary tide of Federal Reserve quantitative tightening and a surge in Treasury issuance.